Okay, we have gone through the last few sessions about the preparing the KYC part. Remember remember the big flow chart, the wealth management flow chart. So right now we are still on the process of the client profiling section. And then in the client profiling sections, today we'll talk about the how to determine the client's goals and the constraints, and then how do we create the investment profile of the client. And then I will share with the group some of the tools right now the private banks are using. So you will find that basically the private banks are using is quite theoretically similar to what we have been discussed throughout the lectures. So from T. Rowe Price. T. Rowe Price is one of the famous fund managers in the US. They're covering asset, fixed income, and equities. And then it's one of the founders mentioned that it changes the investors only certainty. So that means investors always have to change in their mind, not only in the change in mind, but also change in status. That's why we have to know the client's goal and the constraints throughout the life cycle. So what are the goals? The goals I'm talking about is not as a bank or as a service provider, the goal of myself. It's goal of the client. So remember, the goals are client driven. What are the needs and what are the circumstances and the experience of the client? All these will affecting their goals. And then, because when you talk about goals, so since we are talking about money, the business of money, managing money, so that's why the goals have to be numeric, and then we have to be specific, and we have to prioritize what are the goals. Otherwise, if you say, for example, if the client say that my goal is to make the maximum money I can make, so what does it mean? So say for example, a person saying that I want to maximize my profit, then it is impossible to quantify. So that's why you have to quantify and specify the goal, and then the best is that you have the time and data specific and prioritize. Also, the best is that you have to define goals with some specific situations. Say for example, I want to have my portfolio, say grow by 8% per annum. So probably around 6-7 years I can double my portfolio provided on a continuous and then the compound interest basis. However, by achieving a double in 5 years, you have a lot of ways to do so. So you can have, say, in 2 years' time you make double and then do nothing, or continuously, consistently gain the average return. So that's why you have to define the goals and how you achieve the goals. Why I say that? Because if later when we talk about the investment policy statement, from the spectrum of investment, so say for example, my left hand side is the safest, which means the cash and deposit, and my right hand side is the most high risk, high return, and then least uncertainty return is you invest in the venture capital. So cash and the venture capital are two extremes. So if, say for example, and in the middle, say for example, in the middle is bonds and equity, like global equity or whatever, which give around, say for example, 5 to 8% per annum with certain volatility. But the extreme of venture capital can give you 10 times return or 20 times return if you're lucky enough. But however, you are very unsure, because if you invest in venture capital, so everybody know what is venture capital, right? So if you invest in venture capital, you don't know whether the company will succeed, survive, or grow or not. So that's why you may probably invest in 20 companies, 80% may be lost, 20% gain by say maybe 20 times, then your average probably maybe 10% rand IRR. So at one point of time you invest very high risk. Say for example you have 100 units of wealth, you put 20% venture capital, and 80% in cash. So that means your 80% is very safe. So leave the part that gives you the highest return. But from 10 years down the road, probably your return is also 10% per annum compared with a balanced portfolio. So it really depends on the risk profile or the preference of the specific client. So I'm not saying which one is bad, which one is good. Both are good, that you can achieve the long-term objective, but the path is so different. So this is the why we need to define the goals more specifically when you discuss it with your client. Of course, when we go over that, a lot of other constraints that will limit your choices. So the third one is hidden goals. You talk about what are any specific goals that is not covered. For example, some of the goals, say for example, if you're an entrepreneur starting your own business, and then you accumulate certain wealth, you do some wealth management, but your business is still growing. But at the same time, you just married with a young kid, very young, say a couple of months baby. Then you start to think about it. Okay, what in case some accident happen on myself or the company, and then I have to take care of my family and then the kids. So that's why you may have some emergency reserve. What things happen gone wrong? So that means I cannot put everything into venture capital because I cannot take money out if I need money. So that's why you have some insurance coverage for emergency reserve. And this is what regarding the risk management. How do you manage the unexpected events happen throughout your life cycle? So this is something you have to consider. Because we're dealing with human beings, we're dealing with personal wealth. That's why all these soft factors you have to consider. And then there's some non-investment goals. For some say short-term goals, say like short-term liquidity needs or against long-term investing. Say for example, right now, if the client say that I want to deploy all my money into investment, but suddenly, like Hong Kong, you see the property price drop 40% for some of the good projects, and then he suddenly want to buy a property for, say, to change his homes or etc. So these are the short-term liquidity needs which may arise, or they have an accident operation which liquidity needs. So that's why these are the non-investment goals, and we have to take care. And also some intermediate goals, say for example like children's education, weddings, second home, trip around the world. So these are the intermediate goals. So you'll find that all the goals have certain similarity. Can you name what are the similarities? The constraint of the goals are so the similarity that is cash flow. So remember that investment is that you have some cash outflow. That means when you start investment, you put some money into the investment project. The return is your inflow. So, but during the investment period, you didn't have the return coming yet. That's why you have to prepare something for the intermediate goal, which is the unexpected cash flow or some planned cash flow. So all, in the end of the day, when you deal with money matters, the biggest concern or biggest consideration, say in your future, when you're planning your business, is cash flow. Without cash flow, it's very difficult for you to plan a lot of things. Even you have very good assets, you have no cash flow, you still will die. Just in today's world, when interest rates are rising, you have good assets, but you have liability due. Your credit, say for example, your credit card payment due. What happens if you cannot pay? Your credit card loan will become exaggerated. So cash flow is very important. So in that way, I think in your study of investment, like valuation of equity valuation is the future value discounting cash flow. So all it is talk about cash flow is the same for this area. So that's why the goals talk about the cash flow consideration. And that's lifetime goal. So why people want to invest? or why people want to invest for retirement, because when I retire, I have my human capital drops to minimum. Say when I start working at 25 years old until 60 years old, so basically I exploit all my human capital. So then I have lived with my wealth. That was the retirement goal. So like what I did. In order to be financial independent, right now a lot of people talk about 财務自由 financial independent or 财務自由，就是说 that means when you're a certain stage that you financial can support you maintain your comfortable standard of living. So I'm not saying luxury, so everybody's comfortable is different. Somebody say that when I fly, I need to fly business class, I feel comfortable. So somebody is flying economy, you feel comfortable. So the comfortable standard of living, you need certain financial support. And then also like the expenses, classes, what are the basic living expense, etc. All these are goals for you to set. And then of course the healthcare. So right now people need to buy the insurance because and people can foresee that the biggest bill in your future expense will be regarding your healthcare. So that's why these are the things that are the goal setting for a general public. I mean that he has general public, but not necessarily applicable to ultra high net worth or high net worth people private. They have different goals. And then of course the later part is the regarding the if you have surplus wealth, then how to deal with the surplus wealth? Then you have the transfer goal. So excess capital for your children, grandchildren, or you have no sibling, not married, then how to deal with your money? So maybe you give to a charitable organizations, and then how to do it and when to do it. You cannot do it too early, or you cannot do it too late. That's why you need planning. So last but not least is the tax implication. What's the if you live in Hong Kong, so the tax is not simple. But if you live in US or even Europe or other high tax jurisdiction countries, tax implications means a lot, especially when you want to pass your wealth to your second generation. For example, like US has certain state has a very high estate tax. Say like if you get 1 million to your kids, probably you have to pay 30-40% tax to the government. In Hong Kong, no tax. So that's why people like to leave money in Hong Kong to pass to siblings. But if you are having son or daughter is living in USA, then you consider how to pass the money to them. So that part we will talk about it when we have the wealth succession lecture. And the goal priority is it is the client's responsibility as the wealth manager to assist. So all I mentioned here is that as the wealth manager or wealth service provider, you cannot decide this for your client. You should help them to decide these goals. So the goals give the direction and the start of the wealth managing process. Without that, because without a goal, without objective, without direction, it's very difficult to do so in a perfect way. So next, when we talk about after we quantify or visualize the goals of the client, then we have to talk about the risk objective, risk and return. So we have the identification of the risk objective. So clients prefer to define risk expressed in dollar loss amount rather than percentage term. This is a general behavior that people like to see. Say for example, and so my experience that I didn't study wealth management when I practiced it in my career, but when I start picking up teaching, I went through the textbooks and then the theories, and I find this space is really interesting. So they said that client prefers to define risk express dollar loss amount rather than percentage terms. I start to test it with my client, and I find it is pretty true. If, say for example, the client has $10 million, and then he lose 1%. So what's 1% of $10 million? It's 100,000, right? So, but 100,000 is sounds to be a lot, but compared to 10 million, it's not that much. But say for example, if you told them that, okay, you have this position losing 100,000, he's so worried about it. Why you lose so much? Or even 50,000. When the amount is 50,000, it seems to be very large. But 1% seems to be very small. So this is, if you think that it's quite, not, it should be, they should rational compare the actual sum. But however, in most of the case, people are so worried. So sensitive to the dollar amount instead of the percentage. So, and everybody knows that the common measurement of risk is the standard deviation of return. We will not go through the calculation, but I assume that everybody knows how to calculate the standard deviation. But however, I would say that the standard deviation of return is not exactly the measurement of risk. So this is the measurement of volatility and swings. So why people would like to link risk and swing? Because the movement that will be, people think about the risk because it moves up and down, both are risk to the client. That's why sometimes when you read the financial articles, you see that the risk is on the upside. And the people will think, why the risk is on the upside? Well, upside should be happy, right? When you buy something going up. So why we say that? Because if you expect something, it should not gone up that much. If it's suddenly gone up that much, you have to do something. Because as a financial world, if the thing that should not gone up and then gone up unusually, it will coming down. So this is, we call it the mean reversion. So that's why when things swing either up or down, it means that normal. Then we have to deal with it. So that's why we think that that's why we would like to use the swing as the measurement of the risk. And then for individual clients, risk also equal to the chance of not realizing their goal. So remember that like in the previous page, we set up that client has specific goals. And then if he set the goals, but his financial plan will not be able to achieve his goals. So what's the purpose doing that? Or his goals is too unrealistic to achieve. So probably throughout his life, he will not be happy. Because in any case, he will not, say for example, I have $1 million. I would like to become $100 million worth after 5 years. If he have set that goal, so probably you think that is ridiculous, right? How can you be your grow 100 times after 5 years time or 10 years time? Impossible. So in that case, the goal will never be achieved. However, so sometimes if you have large wealth to manage, and the goal is setting too low, that means you are not achieving the right kind of return. So that means you will waste your wealth will be waste. Take for example, if right now deposit is 5%, so in US dollar deposit. If I have $1 million, that means if you do nothing, you earn around 50,000 per year. And you say that, okay, I didn't need that much money, so my objective is only 3%. So in that case, I don't do anything. But however, you can make 5% safely. So that's why I think that in this case, if you just say that by achieving the goal and doing nothing, or even not doing deposit and putting in cash account, you are just wasting your money. You have that resources, but you're not using it properly. That's why we think that by investing the money, that you have to properly allocate the risk to your wealth. And And sometimes you have to talk about the absolute and the real rather than the relative market index. The relative to market index of peer. So what does it mean? Remember that we talk about the people with more sensitive to how much number, the number, exact number. But however, sometimes you have to make relative to the market index or peers. Because why does it mean? Because say for example, if you have a friend saying that last year I invest in this blah 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 and I make 10%, and then but your investment only make 5%, you feel sad, even though you make 5%. You say your goal is making 5%, but the one next to you making 10%, you feel sad. That's why we have to talk to the client that not always compare with somebody you should not compare. So same for investment, same for studying. Say for example, if they like this class, so if when you enter the course, you're expecting I put so many effort on the course, I would expect I will get a B plus, say for example, and then the one sit next to you get an A or A minus or whatever, say for example, something like that, and then you feel unhappy about it. But you haven't set because you have to set a goal that I put so much effort on studying, that's why I should get a B plus. So totally achieving your goal, but you're not happy because you compare something that is not within your original plan. So if you didn't know that somebody really put double of your effort, and then say you study 5 hours a week, he studied 15 hours per week, he get an A minus and you get a B plus, you should be a lot happier than him, because by economic, your marginal return is not high. So I tell you a true story. Anybody know James? You know, what's the English name? He used to be a very famous economist in Hong Kong, and he also is the professor of economy in the University of Chicago, and he writes so many books. You can check there. One of them, he wrote a book in Chinese, and then he always quote his conversation with his son, and then try to apply the theory on the economics. And then that day he talked about marginal return and marginal utilities, and then he asked his son, and his son he studied university, and his son is what is so great? And then his son proudly told his father that I got an A plus. And then he thinks that his father will praise him because he got an A plus, right? Oh, very good son, you got A plus. And then his father scolded him, that you stupid, you spend so much time and to get an A plus. While you can spend another, say for example, you spend 8 hours to study to get a B plus, and then you spend 80 hours to get an A plus. You're wasting 70 hours for other high return projects. So that's why he tried to apply this thing. So that same thing for investment. So that's why if say for example you want to achieve so much return, but you have additional leverage and additional risk. The risk adjusted. So remember the term, the risk adjusted return does not fairly reflecting your portfolio. So that's why there's no one fixed rule, which is high, which is low. And then later I will talk about the risk profile of individual client, and then two concepts: the risk tolerance and risk capacity. And then whenever things happen, use a conservative approach when in conflict. What does it mean is that, say for example, when risk tolerance and risk capacity have conflicts, so you have to make sure use the more conservative approach, make sure the client will not lose a lot of money. So I will explain it later in detail. So this is in the textbook that the personality type will affect people's risk profile. According to this scholar, So that the decision, if the person is more on the decision based and primarily on thinking, and then he will be more risk averse. And then he will be individualist, and then just very spontaneous people will be more less risk averse. And then the decision based primarily on feelings, he will be more cautious. And then will be more risk averse sometimes. But however, he will for more spontaneous, and then for the spontaneous people will be less risk averse. So what does it mean is that that's why people say that when you study more, you tend to take less risk. When you're a pure gambler, you doesn't think too much, just by feeling. Just like say for example, anybody ever enter into a casino? Okay, when you go to a casino, when you go to a table to put your bet, so you see somebody will do a lot of calculation, blah 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 thing. Basically, it's all waste of time. All this, if you go to casino, basically pure probability, pure luck. Less than 50-50, I would say. So if you go to baccarat, it's almost 50-50. Say like whether you put the bets on the player or the poker. So basically, is that when people more on the feeling side of things, they will tend to be more less risk averse or more inclined to taking risks. This is the personality. So why we want to study it? Because as I mentioned, we are dealing with human beings. So when you deal with human beings, so their characteristic as human being behavior will determine the risk profile. So what are the constraints? When we talk about the goals and constraints, we have goals and also we have some constraints. The constraint is the situation that will affecting your decision making. So for example, here's the main constraint when you set a investment policy statement, like time horizon, the first one. What are the time horizon? And then that means how long you want to put in your investment. This, when you go to a bank, I think that for your next practices, you may go to a consumer bank and then assume you want to invest in some products, and then they will go through a lot of these things with you. So it's a good practice. So like time horizon, they will say, okay, they will say, oh, what's the investment time horizon or investment time frame, like 1 year, 5 year, 10 year, blah, 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 something like that. Say for example, if you say that the shorter the time horizon, the greater the liquidity constraints. So these are in reverse. So if you need the liquidity, what a liquidity that means liquidity means you can exchange your investment product into cash. That would be the liquidity need. So the liquidity will have, so if you think that you need liquidity anytime, so you have to put into investment that you have a market that you can always sell it. Like FX currencies, like liquid bonds, like liquid equities or mutual funds or ETF. So you cannot buy real estate, you cannot buy private equity, you cannot buy a product that have a lock-up period. So the shorter the time horizon, the greater the liquidity constraint. That means you have the shorter time horizon. So say for example, if I want you to say give you a 3 months time horizon to invest in stocks. So if you think that you pick a stock that have a very good business model, and then next year's earnings, blah, 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 something like that, all this will be a waste of time because you only have 3 months. So this is why the time frame will affect your decision making. So within the 3-month proper, you choose something that have a momentum trading, and then more the flow will determine the risk and return. So usually client can accept a risk for longer term horizon. They will have a high return, like private equity, etc. So So price volatility, so the liquidity will have two elements. The marketability, that means how easily you can sell your product in the market price, and price volatility, how is the volatility of that instrument. For example, like if you want to liquidate some Hong Kong stock portfolio, if you liquidate yesterday compared with today, it's a big difference. Today up, I don't know how much it's 500 points already. So in the afternoon, because some talking in China. So that's why the volatility will determine your return if you have a very short-term time frame. But this thing is very difficult to quantify. You don't know what happened, what meant to happen. And also there's some extreme market situation. So what are the extreme market situations? When there's a crisis, when such an event happens, suddenly the market become dead and no transactions. For example, like during the COVID, in year 2020, during the COVID in the first quarter, there was a day when suddenly U.S. Treasury has no liquidity. I don't know why, but just so happened nobody wants to pay, and then people cannot do the repo funding, and then so that's why the Treasury price dropped substantially, and then create a lot of panic selling on all the asset classes. So this is some extreme market situation, and also by the constraint whether you have a cash flow strategy, do you need to a consistent, continuous or consistent periodic cash flow for your investment? Say for example, if when we were in bank, we have to design a portfolio for a client. It's a charitable. We want to set up a foundation, so that each year they will take some money out to do some charitable event. So they calculate based on the volatility of the investment, based on the interest rate and the cash flow generated of the investment, how much withdrawal he can fulfill or he can promise, because he doesn't want to over promise for donations. So because if you promise to donate some money to a charitable organization and you cannot deliver, so the people get provide the service will have difficulties. So that's why cash flow is important, and then also what is reserve. And then the other thing is that the availability of credit facility. This is very important, especially for private clients. So in your normal cash flow calculation, apart from that, we would always try to get a credit facility based on his asset in case he has emergency cash need. So it happens that I recall that once during the last property crash in Hong Kong, and a client come from us. He said that there was a house in the peak was offered in a very good price, but the only condition is that he has to pay full cash within 7 days. It's a very deep discount that a lot of people want to buy because the house never for sale for a long time, and then he really want to buy it, and then but he say for example if the house I offer maybe 100 million US Hong Kong dollars, for example, it's not easy. Everybody will be immediately get 100 million cash or in cash deposit to pay. Usually, say for example, if I'm rich enough, so I can say if I want to buy 100 million house, for example, I have probably I need to prepare 30 million down payment, and then ask the bank for mortgage, and then get a loan and then pay it, right? Probably takes at least 1-2 weeks. The bank needs approval of the loan, etc. Even I'm a very good credit person. So that's why, because the client has a pool of asset in the bank, and then he doesn't want to sell the asset, but the bank has a credit facility for him, so he can immediately withdraw the loan of 70 million and pay the full payment. And then after the short-term drawing loan of the 70 million, and then after buying the house, he then get the house to the bank for mortgage, and then refinance to repay the short-term credit. So that's why the availability of the credit facility is sometimes very important if you make substantial investment in a very short period of time, so that you can meet your cash flow need. So because he want to buy the house and then he forced to sell his asset property, he may need to sell at a very low price. So that's why he will facilitate his credit needs in a short period of time. So these are the constraints. Also, not in the textbook, I would like to include here is that, so apart from the general goals and objectives on wealth management, the Asia high net worth and ultra high net worth clients tend to have more specific common goals and objectives on their wealth management due to their different political background and jurisdiction. This including wealth transfer, so these are very, very prominent, especially right now. For Hong Kong, a lot of the wealth is already from first to second to third generation. And also succession planning. So this succession planning, I mean, not only on wealth succession. So we will talk more about wealth succession, but the other angle is that when you go to private bank, actually business succession is also very important for high net worth individuals. So think about that. If I am an entrepreneur, I start my factory 40 years ago. From 3-man factory, now I employ 10,000 workers. And then have factory in Hong Kong, China, Southeast Asia, Vietnam, everywhere. And then selling to globally. Very good business. So, but I'm approaching 70 years old. So my factory is not business. And then some of my employees continue to be 60, 50 years old. So think about it. If you own them, what's the factory's future? So the factory employ 10,000 workers. So you cannot close it immediately because you have the social responsibility. And then even in China, you're not saying that I want to close down the factory. It's not that easy. A lot of the for ongoing compensation, etc. So that's why business succession is another area that have a huge concern, huge consideration for the high net worth individuals. So the factory is still making money, very profitable, but you still need somebody to run, need somebody to manage for the business. That's why business succession is one of the headache for the ultra high net worth individuals. And the second one is the tax identity, especially for mainland Chinese clients. So you have to understand what kinds of potential tax liability you are having if you are ultra high net worth individual. So as I mentioned before, Hong Kong is perfectly okay. But if you are an American citizen or you have a mainland Chinese citizen, if you are Canadian citizen want to move back to Canada. So a lot of these tax identity you have to deal with. So that's why right now in Hong Kong Hong Kong try to promote Hong Kong to be the family office hub for the region. That means people when they move their tax identity into Hong Kong help them to gain this tax identity. He becomes a tax resident of Hong Kong so that he can give up his original tax identity and then enjoy a lower tax regime. And also the last is the inheritance of family value and legacy. This is more subtle. So some early founder of a family that after they may have the certain family value. For example, like I think about Lee Kum Kee is one of the famous oyster and oyster sauce and also the cooking sauces in the world so many years. And then among his family governance, they would say that if anybody of his future generation, if they divorce or whatever, they will lose the ability to receiving family wealth in future. So that's why some kind of these family value legacy will happen. So these are the constraints on the goals of the Asian high net worth and ultra high net worth. So how do we define the goal and then and constraint? So we have certain gathering some data and analysis, and then we will try to decide his, we call it investment suitability assessment, and then we will try to know the client's risk tolerance and the risk capacity level. So that's why we would define the risk profile. But how to do it? So now this lecture will talk about how we do it. So first we define what is risk. So risk is the client's most restrictive investment constraint. So when you invest, so we talk about risk and return. So and then even you go to the bank will emphasize a lot what are the risks of this product. In the same case, we will talk about risk and return of different products later in the later stage. So risk against uncertainty. So risk is the quantifiable concept, and uncertainty is a circumstances that no probability of developing a quantitative determination of true probability. So risk is the very the concept of risk is, according to some definition, is very different from person to person. However, in our financial industry, you still want to quantify it by means of using some scientific methodology to quantify it. So first, we have to know two concepts. The first one is called risk tolerance. So what's risk tolerance? Risk tolerance is the risk threshold. That's the limit of acceptable risk, the maximum level of pain. Remember, the maximum level PAIN, the pain before you're giving up. So no numbers here. It's the maximum level of pain. How to quantify the level of pain? Everybody's pain level is different. The level of market volatility that a client may find most uncomfortable, but he or she will not call the investment and say, I can't stand it anymore, sell it out. So that means when up to a certain level, somebody really cannot stand the volatility. He would like to sell out and then doesn't want to see it anymore. And then determined by internal factors, and then determined by the attitude and personality. I will give an example later for you. And conflicts between objective view of risk and emotional view. So and also client knowledge level against the biases. So these will be a lot of psychological. So risk tolerance, I would say, is more a psychological characteristic of the person. So then here there's another phrases that the willingness against the ability to accept risk. So willingness to accept risk is not the same as the capacity to accept risk. So somebody would like to take risk, but he do not have the capability to take risk. So wealthy people may not like to take investment risk. Why? Because he's wealthy already. I don't need to make such money, and I don't want to lose. And then he doesn't want to make money. So that's why he has the capacity to take risk, but he doesn't like to take risk. People who are successful may not like to take investment risk. And then AUM threshold is only the first step. Need to do segmentation by risk tolerance level. So another concept is the risk capacity. So the risk capacity, that means the financial capacity to withstand market losses. So here that the financial capacity to withstand market and determined by objective and external factors. Okay, I give you an example. You understand. Same investment. Okay, everybody knows that. I like to quote this stuff because it's more easy to visualize. So you know that in South Island Line, the Guangzhou-Han Station, there's a huge residential complex, right? So everybody have ever exit that station earlier in the last couple of days. So you see a lot of real estate agents selling you, okay, 40% discount, 30% discount on the purchase price, right? So say for example, 3 years ago, this property, say for example, sell at 4 million. Think about this. This is very practical and useful for your future decision making. Say for example, this price is 4 million Hong Kong dollars. You buy assume it's say, how big? 20,000 square feet. 30,000 per square feet, like this, something like that. Like, doesn't matter. So assume it's 4 million. And then at those days, you only need to pay down, because in buying property in Hong Kong, you have two methods. One is to, they call it immediately mortgage. And then immediately the bank will lend you money, and then you pay down the deposit, and then start to pay the loan, pay interest. But that will be, you get a bit discount. But however, most of the people would not like to do that because he doesn't want to pay interest immediately. So they would like to pay down the down payment. They like 10%, and then the later stage rate, they assume like 30% down payment. Say 30%, you pay 1 million, 1.2 million. So you pay 1.2 million to real estate developer. You still owe him 2.8 million. So this 2.8 million you will only have to pay when the flat is ready. So say like you paid it 1.2 million 3 years ago. Now when the flat is ready today, you have to pay 2.8 million. So usually people think that okay, I pay 30%, so assume that if the property goes up, I can sell it and make a profit. So I don't have to mortgage and then penalty and blah blah blah. So easy. But and also somebody said that okay, I don't want to engage the loan, I don't want to pay interest first. That's why you can pay the payment of interest. So these are good suggestions for good decisions. However, the property price dropped. It's true. 4 million now worth 2.4 million. So your property becomes 2.4 million. I say 2.4 million. And then you still owe the property developer 2.8 million. So that means right now, if you can pay the 2.8 million to the property developer and then get a 2.4 million grant. So market you lose 1.6 million. Still okay if you can pay the 2.8 million. However, most of people do not have 2.8 million. So okay, if in this case, okay, I don't have the money to pay the 2.8 million. What I can do, I can borrow. So we ask the bank, loan, mortgage. Assume the bank can lend you 70%, but it's not a fault, because now only worth what fault. So the bank can only lend you maybe say 1.68 million. So the bank can only lend you 1.68 million. So if you want to settle it, you still have to pay cash for the difference. So you owe 2.8, you still pay 1.2. You got 1.2 in order to settle it. So that's why you see a lot of people rush to sell, because they cannot, either they cannot pay the cash, or they cannot get the loan and then pay the balance to the developer. So sell, hopefully can sell the market and get back some, otherwise people don't know. So okay, think about the if you buy this 4 million flat and then pay 1.2 million, and then you think that in future it will go back up to 4 million, that means you can, if you have the cash, you can settle it and then wait for price goes up. So in that case, you have the capacity to pay the risk. But in the second case, you don't have the cash, you're forced to sell because you have no cash. The property developer will chase you, and then they will force you to sell, and then the balance they still chase you for the loss. So that means under the second case, you don't have the, you will not have the risk capacity when you buy them. But both are likely to the risk because the same instrument. So this is one example. Real estate. For financial instruments, for example, same thing. Okay. If you buy a bond, okay, everybody remember year 2022. That was what happened in 2022 was one of the most significant events I experienced in the capital market. You guess about what happened in 2022? Anybody have a clue? Affecting internet, affecting everybody. Happened in 2022. It's a rise in interest rate from 0 to 5%. So think about that. So that was the fastest rise in interest rate in history of last 30-something years, from 0% to 22.2% to 5.25% within how many months? Within a year, couple months. And then think about that. If you buy a bond, any bond. Yield of 3%. Say for 25 bonds. Okay. It's okay that if you buy a 10-year bond, 3% yield, so every year you get, say you buy $1 million US. Every year you get 30,000, right? So normal. If you buy a bond, 10-year bond, 30,000. Okay. At those days, borrowing is only 1.5%. Borrowing cost is 1.5%. And then the bankers so smart telling you that, oh, you don't have to pay 1 million. How about that? You have 1 million, how about you buy more? I lend you another 90 million. You say, for example, how about you want to make more return? Say, instead of buying 1 million, you buy 3 million. And then I lend you 2 million loan. And then I lend you at 1.5% and then you make 3%. Sounds very good, right? Your ROE is a lot higher because you're putting 1 million and then you can collect 90,000 coupon per annum, but you're paying 2 million of loan. That means you get 60,000 instead of 30,000 after interest cost because of 1 million. Your ROE will be double. Okay, think about that. On the next year, because of interest rate rise, your bond price drop. Because why 5%, 10-year bond, 5 drop around how many points? 10-year bond probably drop by around say 10%. Well, not more than that. 5%. Drop around 30% because of the long duration. So your bond price, your bond now worth $70. mark to market. But you're still collecting 3% interest, right? But interest rate right now rise from 1 to 5, so you're negative carry. And then your mark to market loss. And then the bank said that, okay, sorry, Mr. A, I cannot lend you 2 million. I cannot lend you 2 million because you dropped. So you have to top up margin, you have to bring more cash in order to do that. And then said that, okay, I don't have the cash. What should I do? So you have to sell all your portfolio. That means your 3 million bond, at 70,000 you can only get back 2.1. And you owe the bank 2 million. So that means you get back 100,000. That means you do 90%. So that means, say for example, because of the market events, so if you are holding 1 million, you don't have to do anything. Disregard how it moves. Nobody will force you to sell. But when you're borrowing, your leverage, your capacity is subject to deteriorate. That means you cannot. That means you cannot sit with this position. Okay, same case happened on the. Remember that early last year, first quarter last year, the regional bank in US, the Silicon Valley Bank, having the same problem. Because we bought a lot of long-dated government bonds, financing by short-term deposits. When people suddenly become deposits, the bank becomes insolvent. So here they explain that your risk capacity cannot allow you to leverage in case a worse situation happens. So that's why even though I want to take this risk, but I know that when things turn bad, I cannot sustain. I cannot sit through the cycle. So that's why you have to consider the risk capacity of your position. Even though I want to take this risk, but I know that I may lose total loss. So
it's okay.
this is the case and happened. So in this frame, so if the risk tolerance level is below average, and the risk capacity, one side is risk tolerance, one side is risk capacity. If the risk tolerance is below average, so we rather, if the client is also risk capacity is below average, so the client solution for this is below average risk tolerance, do something. And then if the client is has above average risk capacity but below average risk tolerance, then you have to think about something that you can do. So that's why when we design a portfolio for clients, make sure that we would like to do something that he can achieve in the long term. Say for example, if he has that risk capacity and also he has high risk tolerance level, so he can take very high risk investment because he can sit through it for the cycle. Say for example, say I take Tesla, the stock Tesla as the example. So everybody knows Tesla, right? The stock price come up from very low level to above 700 and then now get back to 200 something. But during the rise of the Tesla, between has gone up to 500, 200 something, and then big swing. So if think about that, if you don't have the risk tolerance level, if you see the stock dropping from 200, 400 to 300 or 100, 200, you will not see through it. You'll be so scared and to sell it. Or if you borrow money to invest, you margin call already, you're cut. So that's why in order to earn this big movement, so you must have strong risk capacity at the same time high risk tolerance level. So that's why this risk tolerance and risk capacity is very important when you decide whether you can invest or you should invest in certain projects. So in order to determine how to help people to know yourself whether you're high risk capacity or risk tolerance, we would like to sign a lot of these investment questionnaire. So what are the questions? These are the typical questions. Question one, what is the approximate value of its investment portfolio? Refer to ask, how much money do you want to invest? What percentage of your total investment is represented by your portfolio? That means they will also ask, you say for example, you come to the bank and open an account and you put 5 million with me. And then you said that I will check, I will ask how much your total wealth, say, oh, I have 100 million. 5 is represents small amount. So you know that the client's capacity is very huge. Second question. Is there an immediate or near-term need for your income for this portfolio? This will ask about your cash flow requirement. And then question 3, will significant cash withdrawal or principal contribution made for the next 5 years? Basically, it's similar question. You just want to ask in a different way to make sure the client will give the same answer. Question 4, we would like to be involved long-term investing. So what's the time horizon? Because if you say that my investment time horizon is only 3 months, so probably you won't need investment advice. Basically, you just put it in deposit, do nothing. So that's why risk assessment, you have to make sure they have a medium-term to long-term investment horizon. Question 5, what's the annual return? And then on expected inflation. So this is something helps to set up the investment goals. Question 6, for this is very important. For each of the following attributes of an investment, circle the number that most correctly reflect your level of concern. The more important the higher number, you may use each number more than once. So why we want to do that? Because we would like to know the client's concern. Say for example, his concern is say for example, if you put absolute persuasion is the higher concern. So you know that his risk policy level will be a bit lower or pretty low. But if we put that aggressive growth is my highest concern, that means my objective is to make as much as possible. That means he will prepare to take more risk. So these are the risk assessment answered by the client. Question 7. Do you have any cash asset class constraint or limitation? So this is something that you want to know his experience and then his volatility, how much volatility you can take. And then these are the assessment of the market, the instruments you can take. Number 8. Similar to question 2, 3, and 4, just reinforcing a long-term investment horizon. And then up to what percentage of this portfolio can be best invested in long-term investment. Okay, this is the question similar to objective similar to this one, but just presented in a more numeric or quantifiable numbers way. So he will ask that the following statement, the statement that would worry you the most. That's the number 1. So I would be very concerned if I did not achieve the return on my portfolio that I expect. That means his number 1 concern is try to make the target of return. I would be very concerned if my portfolio was worth less in US dollar because of inflation. Similar thing. I would be very concerned if my short-term volatility with short-term. That means if we take this as important, that means his risk tolerance level is pretty low. I would be very concerned with long-term volatility if my portfolio drop in value over a long period of time. So this is that means he can take more volatility but still have concern. So these are the quantifying the level of psychological, or not psychological, the portfolio risk. So question 11, it will talk about how long you can stick with the portfolio in order to regain the previous level. That means how long can you stand for market loss. So this is a similar question. Is that if my portfolio has a long-term return that allow me to accomplish my goal, I'm prepared to live with a time of recovery. So like saying that because during the 2008, the great financial crisis, it really did need to take 3 or 4 years for people to recoup the losses. That's why if you cannot recoup losses for longer term period, that means you cannot suffer such drawdown. Okay, this is the talk about the tolerance level and the market level. I would be out of the stock market when it goes down than in the market when it goes up. I would rather be in the stock market when it goes down than out of the market when it goes up. But I can live with the volatility of the stock market in order to earn the market return. So this is also is the measurement of the people's psychological risk tolerance level by means of asking these different types of questions. So after all these questions, this is another psychological question, and then we will, when we go through the behavioral finance, we will go into detail why we pose this question. And the thing about that, this question is very interesting. Now is the test to take. These are 2 parts to the test. So part 1, choose A or B, and part 2, choose A or B. So read about it. So A is that you win 80,000. Question B is that you have an 80 chance of winning 100,000, or a 20 chance of winning nothing. So that means by probability is also 80,000. So part 2 is that choose A or B. You lose 80,000, or you have an 80% chance of losing 100,000, or a 20% chance of losing nothing. So on part 1, which one do you like to choose, A or B?
A.
On part 2, B. Okay. Very normal answer. And that is quite true. Basically, the question is the same. The A and B is the same. Because according to probability, it's the same. But however, people, when winning, people like to choose an exact number. When losing, people doesn't want to take loss, and they like to have a chance for not losing. So this is exactly reflecting the psychology of people, and that is happening in investing. Quite true. So that's why it always happens that when people taking profit too early and cutting loss too late. So this is exactly reflecting. This is the prospect theory that we'll talk about it in detail in later lecture. So these are the some statistics. So you see that statistics from 1926 to 2009 for compound return for these how many years? Okay, 80 years graph. So like large stock is 9.8%, small stock 11.9%, government bond contribute, and then you can see the standard deviation, the swing. So if you want to achieve a high return by means investing in stocks, you see that you will probability of a very huge swing in the equity market. If the people cannot stand this swing, probably cannot achieve that return. So this is another example of the different asset class with different volatility and showing the standard deviation. So this is okay. I deliberately including two large periods say this one, 2008. So to recall, you can, so 2008, everybody remember that we have the great financial crisis, the most severe financial crisis in history. So you see, even you have a diversified portfolio, you still lose 28%. And then if you invest in emerging market Asia, you lose 57%. If you Asia ex Japan, lose 52%. And then for 2009, it rebounds substantial. Say for example, like Asia and Japan, you lose 52%, but you gain 72%. But however, the 70% doesn't mean that you gain back already, because when you are 100, you lose 50%, you start from 50. 50, you make 75, 72% is only around 80 something only. You still, that means you take at least 2 something years to make it back. So, say for example, if you start investing in 2008, after 1 year you lose 52%, what will you do? A lot of people, I think, already know IC, cut loss already, so we must sustain the rebound. So that's why, in order to mitigate the volatility, we try to diversify the portfolio. But even a diversified, you still have to lose 28%. That's why, after the financial crisis, my experience, a lot of clients sell it out during the crisis and hold cash for, because it suddenly become risk averse, and hold cash. And hold cash until the market is settled. So maybe start to invest in end of 2010 and 2011, but he missed the strong demand of the market. So that's why this illustrates that if you don't have the risk tolerance level for such big movement, and then your time horizon is not long enough, you will subject to a lot of unnecessary swing or unnecessary or unsmart or stupid movement by cutting too early or invest too late. So that's why something illustrates that. This is during so if you look at that, even though you subject to 2008 drawdown, you're still making 5.2% annually from a long-term horizon. So this is from 2011 to 2021, before the great drawdown in 2022. So you see that for a diversified portfolio, this is a lot better, 10.3%. But you still have, you see that the swing among asset class, some asset class with high swing. So you see that the high asset class, like for emerging market, it's Asia, down 21%, but next year another rebound 2 years strong. So that's why the volatility is, the volatility swing is really quite a lot. So that's why for a diversified portfolio, like developed market equities, so in the last 10 years, the best performance, but you still have a high volatility overall, 32%. So this is some kind of historical figure will give you a guidance on what will happen in the future. And this is from 2013 to 2000, the last 10 years. So year 2022 is the worst among these 10 years. So for a diversified portfolio, you lost around 12%, or 14%, 50%. Even for, I think the biggest hit is that for investment grade bonds, you lose 16%. That was the highest in history because of the interest rate rise. So by look at that, you start to realize that in order to achieve a reasonable return with a diversified portfolio, then you won't have to subject to such big swing in volatility. Say for example, diversified portfolio, even the return is only 4%, so the volatility is pretty low. So you will see that the last 10 years the return is a lot lower because the interest rate is in a very low base interest rate cycle. So after we do the questionnaire, the client have to acknowledge and sign off. So let's take a break, and then after the break, I will show you the real example what the banks are using. And you find it quite interesting.
其实我还是想要办公室，而且那个地方也没有桌子，这边公司也是不太方便。
看是有没有别人发的，别人发提到的。我给你看米克讲的很高兴。这个太夸张了，超代表情。
不过你选的衣服真的很漂亮，你很适合这种暖色的。你有什么？对，暖色啊，向日葵粉好。暖色比冷色。
超大表情。
那个我长得是喜欢。
很喜欢变。
成语已经是这么用的，我可以出它。我可以说希望变成。我决定要把这个形象拖到这，我又给它拖到板上面，过来。跟着把心很放。他上节课不是说随便画吗？说你只要不永远画就行。
就是非常非常专业。professional。
这不要报告。
但是刚开学你就，
因为我礼拜五要报告。
对啊，刚开学就有睡觉觉。
哦。是吧？那就在学校。
也。
对呀。对。反正我讲完就要回家过节。不要明年再说。
你是星期五走还是周末再走？
星期五走，上个礼拜走了。
这好多人都说周五课，哦，你上午要到。
对，9点半到10点半，但是我会提早点走，因为2点多的飞机。
啊，那是得早点走。
对。然后他就把我排在第一个班。
哦，你跟他讲就行。
然后我们那组很没有。
有那组。
我们就变第一个班。
我心里在上课。对，像我们 professor 也说，他本来其实那天课是上午的，但他说算了不上。
我还特意把报告排在一起，你看他头在一起，很废。他就是不让我进。
我那个 professor，他每次一来就要先一句是那个阿康吧，然后等所有人都说是，然后他每次来都会。
你看到好。
这个感觉每次登场的时候很累。不会还是那一个吧？自恋哪些？你能不能把它保存下来？我没有保存这个视频。哎，兴趣是微信，不是 QQ， 因为会点到，我会一直看到我在逛。不知道，但好像 QQ 看到你去他封面，你看到多少个？第10。第10，加重了。10。就是够了。对。哇，那他的名字里整个3个都是元素。对啊。是那个月饼金属。有一点，他是不是五行缺金的？哎，就是他其实不叫名字，他是他自己给他进去的。对，妈妈本来给取了一个什么鬼，不知道什么名字来着。然后就他那点，对，然后他就是说他觉得执念要叫什么。然后他是本来是一个很正常的，就是跟他聊说你叫什么呀，还是死的。幼儿园的时候。小时候他还挺好奇的。这个名字很适合去做幼教，但是
这个名字好像公务员，就那公务员。
起的有点奇。可以看生命力考了。
他是谁？
他叫陈琳。什么？陈琳是哪个考的？考了强的棒的真大。
他有什么？哦，
来了。没考了出现。
不。
大脸。真的帅气。妮娜的中文叫妮娜叫妮娜包Boland，不是法国人吗？没有，徐什么？我忘记了。是那我在最近学的。啊，不是。
Okay, this is JP Morgan Private Bank is currently using this for do the risk assessment for their clients. So look at that, and you will find is some of the questions are quite similar to what we have been discussing. So you can go through the detail of the wording later. Okay, let's go through some of the questions like willingness to take risk. So you find that this is resonate with some of the questions that asking the risk profile. So we try to illustrate the possible risk and return characteristics of the 4 investment portfolio, like A, B, C, D. So which one you like most, or which investment is generally the most comfortable owning. So if you are very risk averse, you choose the one. Choose this one because the maximum loss 8%, potential gain 18%, but the average is 2% per annum. And it's B, C, D. So potential you may lose 50%, and then also may gain at one point time 150%, but average long term 25%. So this will determine the strength of the portfolio. So this is something a question. If say for example if you pick A, so means you are So equity market, among others, has the potential to experience significant volatility. The volatility was caused by a broad market downturn. What do? Sell a majority of investment, hold a majority of investment, hold and even buy more. So it explains your behavior and your risk tolerance level. Have you used a credit line or borrowing to invest? So this one to experience, this is specifically if you have used credit line to invest, that means your risk tolerance is even higher, but also at the same time they will reflect your risk capacity. If say for example, think about that. If you think that you have ever used a credit line to invest, that means you probably may have some other portfolio with credit already. That means your capacity, your risk profile is already, how to say, become riskier. Say for example, if you apply a credit card, and then the bank will ask you, how many credit cards do you have? And say, I have another 5. So probably knows that your credit position is not as safe as a single credit card holder, right? So this is another question. Have you previously made investment that may not be sold, redeemed, disposed, or transferred to a specific period? Never. Okay, so interesting. So that means you talk about your drawdown, or what's the capacity you can hold for long term. And then the follow one is the people want to describe description of your own, like minimum investment risk, income focus, and capital appreciation, capital aggressive. Question 5. Capacity to take risk. So you see that part 1. Willingness to take risk. What is the willingness to take risk? That means your risk tolerance. This is just another word. And then part 2. Is the capacity to take risk. So it's the same thing that they will ask the same question similarly, is to try to describe what are the capacities you have. Like what is the investment time horizon of your portfolio? How much your JP Morgan portfolio will want to appreciate within the next 5 years? Indicate your overall knowledge of the financial market. What is the reference currency? And then what's your income per annum? Because it describes your cash flow capability. What's your gross income and expenditure? And then last is the foreign credit composition of assets. So this is, I would say the number 13 is not necessarily regarding the risk profile, because the bank just want to reduce of this situation to gather more information from the client. And also the debt situation is that they would like to know your borrowing capacity. And that's the declaration signing. So this is the, right now they're still using this for suitability assessment. And then after this, after you fill in all these questionnaires, what the bank said they have a systematic way by analyzing the answer, they will give you a score, and then the score will classify you as what types of risk rating client. Say for example, if you choose all the conservative answers, probably your risk rating will be very low, and then some of the products you may not be able to invest. So or some products you can invest. Say for example, if you choose that So they have a kind of methodology to scoring the client and then to do the risk profile. And then every year, out of every 2 years, the client have to resign. We do the risk profile because you may throughout the time you may change your capability or you have wealth situation may change that will affect your future risk profile. This is a must right now for all the banks. You do a risk profiling for every client before investing, including security firms, including retail banks. So they just similar but may not be exactly the same format. They do have certain kind of questions for the client to answer. And I would say that right now the questions become more and more specific and precise so that there will be less argument when come up with the figures. Okay, so we talk about risk. So these 2 lectures is focusing on risk before we go to the policy statement. So here is the right now okay, put it away. Actually we finished the last lectures, the last week's lectures. Now it's this week's lecture. So we talk about risk. The last lecture, risk is more about the individual's risk profile, what kinds of attitude towards risk. Now we will turn to the lecture, turn to the area of the market risk and also the risk of the specific product, what kinds of risk you are taking. So what is the investment portfolio? So an investment portfolio is a combination of returns with different risk exposure through different asset classes or investment products. So it's just like you're combining all different kinds of products together. Each product will give you specific risk profile, the specific risk factor, and then all the generated return combined will be the portfolio return. So that's why it is critical to understand what kinds of risk you are taking for each underlying asset in and or investment in exchange for the expected return. Some investment products have higher fiscal risk return relationship. Some will be lower. Today many complex products, which we will have a lecture to talk about the structured product, may incorporate different types of risk in a single instrument, which make it difficult to identify and quantify the risk. You know why they want to design this product? you know when the bank wants to design such product, think of the good way and the bad way. Okay, think about that. So how does bank make money? By selling more products. If the product looks complicated and interesting and looks low risk, high return, so more people will buy, right? So by incorporating several factors into a single product, that means your return should be more than one element. Say for example, if you have Hong Kong dollar, you put into a Hong Kong dollar deposit, so you are earning Hong Kong dollar interest rate. Good job. No more other things. But you think that, okay, now the bank said that, how about you have a currency linked deposit? If you link to a currency movement, I will give you double of the interest rate. And you still deposit Hong Kong dollar. It looks interesting, right? Because you have possibility of earning high interest rate. But remember that when you give you a high interest rate, there must be something there. The financial world is no free lunch. That means there will be some inherent risk there. So I'll give you an example, very simple example. Say, this is also happening in the banks. A lot of people, we call it steel currency deposit. Everybody know what steel currency deposit? Okay, say Hong Kong. Okay, say Euro. Yen. Everybody knows yen more. Okay. Say Japanese yen to Hong Kong dollar. Now 10,000 is equal to 0.1. Hong Kong dollar, say for example, today's exchange rate, 10,000 yen equal to 550 Hong Kong dollar. Hong Kong dollar deposit rate. Say 2%, right? So these are the facts right now. So if you want to put the 3% deposit to what, say for example, 1 month. If you go to the bank and then I have Hong Kong dollar, I want to deposit in 1 month, and then the bank give me 3%, and then the officer tells you that, oh, 3% so low, how about I give you 6% per annum? But the 6% with the condition that links to yen Hong Kong dollar exchange. And you should ask, what's that mean? So if JPY Hong Kong dollar above then nothing happened. If JPY Hong Kong dollar then you have to convert convert Hong Kong dollar into JPY. So you have a condition that if 6% here, after 1 month, is yen, 10,000 yen still equal to 550 Hong Kong dollar, nothing happened. You get back the Hong Kong dollar with 6% interest. While if yen depreciate, and then decrease to 10,000 yen only can below 53 Hong Kong dollar, then you have to convert all your Hong Kong dollar into yen. So the risk is here. That means if the yen depreciate a lot more, you still have to exchange at 53. That means under these circumstances, you are subject to a higher market loss or converting to yen. But think about that, if this risk is more than compensated with the volatility, I'm okay with the deal. If also I'm happy with converting my anyway, I want to go to Japan to travel. In any case, I think 53 is good enough. Then I convert. So it's also okay. So that's why they're combining a put option into a deposit. So essentially it's a selling yen put call option on that. So this is essentially that's why a lot of banks quoting this nowadays for people doing, if they call it currency linked deposit or whatever, or dual currency deposit. However, in most of the case, I think the pricing by the bank is not fair enough. That means they will suppose the market probably may be 8%, they give you 6%. You charge a very huge spread on that. So that's why if you think about it, if the client comes to do a free 1 month deposit, the back office doesn't have performance. But you can ask him to convince them to do this trade, and he earn a commission or spread on that, he can have some performance. Disregard what happened at the end of the day. So this is one thing. But however, I would say that I'm not saying that banks are bad things, but if they think that the pricing is fair enough and it's transparent enough, and they would like to take the risk, this is a very important. Just like you're selling a put option on yen, on yen against Hong Kong dollar. So then, if you have, say for example, okay, if you have a lot of Hong Kong dollar, I don't want to just put in order. You can diversify in the portfolio of these deposit linked instruments like yen Hong Kong dollar, euro Hong Kong dollar, or sterling Hong Kong dollar, Australian Hong Kong dollar, also it's a good instrument, a good way to improve your yield, as long as you can take the currency risk. So that's why the portfolio is a combination of all these risk elements together, and then to give you a total return. So a good investment portfolio should have a fair risk and return relationship. That means you are taking the unit of risk taken is in proportion with the return you expect. So say for example here, so if you say that 6% is exchange for 0.22, say for example you come that do you think it's a good deal? You compare to 53. That means, say for example, if the yen doesn't move or yen still stay the same, I still have to convert. So that means under these circumstances, it doesn't work at all because it should work a lot higher for the money also. So if you're smart enough to know how to calculate. So that's why if so many people offer the similar product, the market the price will become more fairer in the end of the day. So that's why he mentioned that to give a fair risk and return relationship and appropriate allocation of risk budget given the objective and risk profile of the class. So there's two types of investment risk. One is called you have studied before the systematic risk, and one is called the unsystematic risk. So what are the investment risks? So here are the categories for investment risk. First is the interest rate and reinvestment risk. Second is business risk. Third is the financial risk, market risk, and systemic. Of these part is the systematic risk. This part is the unsystematic risk. So I will explain it one by one. So what are the market risks? Market risk is the exposure you taken. That means you're exposed to some market movement. It means your valuation of the underlying asset will be subject to change of the foreign main market, capital market factor. These capital market factors are not uncontrollable, not you can control. You're subject to change. For example, currency. As I mentioned before, yen or Hong Kong dollar is a currency risk. The currency movement, this is a relative performance measure. Remember, the currency is a relative performance. If you are holding in yen, and the yen appreciate, you are making money because you're calculating Hong Kong dollar. But if you're a Japanese person, if the yen appreciate Hong Kong dollar, it doesn't mean anything. If you're still spending in yen in Japan. Same for Hong Kong dollar and US dollar, same case. Yeah, doesn't move at all. So interest rate risk is that especially long-term interest rate, we call it duration risk. That means your asset price will change if the long-term interest rate change because you have studied the discount cash flow. Your future cash flow will be according to the discount rate, and then that's why the interest rate with the PV will be substantially affected. So one general guidance for a 10-year US Treasury, if 1% move on the interest rate, say for example the 10-year Treasury moving from 4% to 5%, your capital price will drop by around 8%, 8 times. You guess if you buy a 30-year bond, if the 30-year bond gone up by 1%, from 3% to 4%, what do you think your capital price of your 30-year bond? Guess. 26. Say for example, so that's why the Silicon Valley Bank has such big trouble. So interest rate rise more than 1% long end. So if you buy a 10-year Treasury bond, so I can show you that if you go to look at the website or next week I can show that. In the low interest rate era, Apple, Microsoft, Amazon, Google, they issue these super long duration bond, 14 years, 60 years, and they at 2-point-something% coupon. That means when you buy the bond, you will earn 3.5% for the next 40 years. But still, a lot of people buy it because insurance company need long duration assets. So when interest rate rise, this bond when you buy 100, it drops to $60 in a very short period of time. So if think about it, if you're leveraged, you'll die easily. So that's why interest rate risk, a lot of people will how to mismanage a lot, and then nobody will think that long-term interest will rise that much. So, but it really happens. So this is once for a century, for example. But interest rate risk, that's it. But if you buy a 2-year bond, it doesn't really matter because if interest rate gone up by 1%, this is only 2 years. You maximum will come down to 2%. That's it. Yeah. So credit. So the credit risk, the repayment capacity of the underlying issuer. So if you deposit money to the bank, actually you're not deposit. By definition, the deposit in the bank's balance sheet is on the liability side. So when you deposit to a bank, that means you're lending money to the bank. The bank owes you money and pay you loan interest. So you're loaning to the bank. But that's, we call it term deposit. So that's why when you deposit to HSBC, you're taking the credit risk for HSBC. When you deposit to ICBC, you're taking the credit risk of the ICBC. When you deposit to the Silicon Valley Bank, you're taking the credit risk of Silicon Valley Bank. When they have solvency issues, that's why a lot of people withdraw the deposit. And in the end of the day, it needs the FDIC, the Fed, to guarantee the deposit. Otherwise, they will become a bank run. So credit risk is another capability. So last week or the week before last, there was one very prominent news regarding the China property market about a company. Who knows? It's the bankruptcy hearing of China Evergrande. Dai. It's become a declared bankrupt, and then they have to start the liquidation process. So think about that. If you're a bondholder of China Evergrande, so you're taking a huge credit risk, and then
because they cannot repay you money. So this is the credit risk. And if you look at the news for neural development, actually neural development right now is still also under some credit situation that people still worry about that they may have difficulty to repay their bond when this is mature because they have over-leveraged quite a lot in the last several years. So neural, you know what's neural, right? K11, all this, whatever, Rosewood Hotel, all this big group. So you're taking the credit risk. If you right now you buy a neural bond, the yield is around 11%. Very good return. You can take the risk. Yeah. So credit risk, equity beta risk is that the equity market directional exposure. That means when you buy a equity fund, so you buy a Hong Kong equity fund. So you're buying two factors. One is the market of Hong Kong market. One is the fund manager, whether they can perform better than Hong Kong market. So you're taking the market beta risk if you invest in Hong Kong equity market. So if you don't want to diversify too much, just take the market exposure, you can buy the ETF, the 280, 2800, the tracker fund. Or if you just want to buy the US market, you can buy the S&P index, SPY, the ETF, then you will purely equity beta risk. You don't have to take stock. But you think that, oh, I think that Apple is a better stock than the S&P, or I want to buy Microsoft is better than S&P. So you buy the Microsoft and the Apple. So you're taking the sector or specific industry risk. However, they will also be affected by the equity market. If say for example the whole market crash, Microsoft, Apple will go down as well, but they may go down less if they are outperforming. So that's why you're taking a market beta when you take that market's exposure. And then if you want to specific sector or specific stock, then it's another sector risk. And what's the mean is alpha. In the term, alpha means you are outperforming of the underlying security over the market. So there's a website called seekingalpha.com. That means people try to looking for return that outperform the general public. That's why in the hedge fund terms, we will use the term alpha a lot. Alpha means that means they can outperform their peers, outperform the market. So when you pay a fee, fund manager's fee for them, that's two reasons. One, you hope that they can buy some underlying stocks that can rise faster the market when the market goes up, or they have the capacity or they have the ability to buy something which is more defensive when the market goes down. So you see that, say for example, when the Hang Seng Index goes up, the underperforming will be the utility stock because nobody want to buy utilities because everyone want to buy the high flying stock. When the stock index goes down, the utility will be very defensive. The money will shifting more to be defensive. The reason why, because under the mandate or the memorandum of most of the mutual funds, they cannot hold cash up to a certain level. That's why they have to hold Hong Kong stocks. Say for example, if your MPF fund is buying the Hong Kong stock mutual fund, so probably maybe 90-something% is in stocks. So if they think the market is bad, so they rather sell the stock that will drop further. So that's why a good manager is they will try to outperform the index. But however, history proves us that for Hong Kong market okay, because Hong Kong the universe is not that much, but S&P is very difficult because they have 500 stocks. It's very difficult to outperform the index by a lot. So is it holding 100% cash is taking zero risk? Think about that. Yes. No, because you lose inflation.
Yes.
Yeah. In nowadays it's okay, today's okay, but in the last 20 years, cash rate is always lower than inflation. That's why you're losing purchasing power. Your money worth less and less, especially for properties. So that's why holding 100% cash is not taking zero risk.
I would like to ask. I know passive investment is very dominant in American or the global market, but why in Hong Kong there is still so many active investment?
Okay, the two reasons why Hong Kong market is still not mature to that stage, but more and more people will buy the tracker fund. And second is that because the Hong Kong index is not representative enough for the broader market. And most important of all, Hong Kong is a very small economy. So in the old days, that's why a lot of the Hang Seng Index now is more a lot these China elements comes into the picture because they represent a larger economy.
So, yes, please.
And also the Hong Kong right now is switching from more domestic into a more China connected financial center. Because good and bad. The good thing is that if China is good, we are good. If China is bad, we are bad. But the point is that if this is not the case, Hong Kong will be very small. Because say for a Hong Kong company, if your earnings are from Hong Kong, how much you can earn? We have only 7.something million people. So it's a very small economy. Otherwise, if Hong Kong is pure Hong Kong pay, we cannot sustain such a big capital market, and we cannot organize so many courses for students.
So does that also mean some emerging market is much more easier for us to manipulate, or for those like bad people to?
Yes. You're right. So for this emerging market, with one or two companies that dominate the broad index, sometimes this is easier to manipulate by playing the one or two stocks. So in the old days in Hong Kong, it's easy to manage with the index. The biggest rating is HSBC and China Mobile. If you control these two names, so it's easy to control. This was I think 10, 20 years ago. Not until they have like Tencent or this big name comes in, and then the dominance of the equity sector, property sector becomes less and less. So that's why the impact is not that easy to manipulate.
Thank you.
So right now, that's why Hong Kong, the HSI is a lot difficult to manipulate than before. Because the Hang Seng Index company is gradually increasing the number of constituent stocks. So apart from the market risk, so these are the main market risks, no more than that. So the other is we call the operation risk or technical risk. So these are not related to asset price, but related to but their pricing will be affected by these operation issues. For example, liquidity, the availability of willing buyer and willing seller of the underlying assets, affecting decision of in and out of a position. Say for example, if now you want to buy a stock, and then you go into the stock book, and then finding this every day only 100,000 turnover, how can you buy it? Or when you're holding 1 million position, how can you sell it? Say for example, if the daily turnover is 100,000, if you want to sell 1 million, you need to tell 10 days. Or if you buy 1 million, you buy 10 days. So probably liquidity is affecting your decision making. So we call the liquidity risk. Or you have holding a big chunk of bonds, and then suddenly no market, and then liquidity is very thin, so you cannot sell it. It's pointless. That means you have to hold until maturity. Pricing. So the pricing risk is the availability of this somehow is a bit of related, but not exactly. So pricing, what's mean by pricing? The availability of secondary market pricing. That means you're holding a stock that somebody would like to quote a price for you, sell or buy. So this is called the secondary market pricing. For example, like the one I quote, if you do instead of you do instead of doing 1 month, 1 year, I give you 10% like that. With that same term, 1 year, instead of 1 month, I give you 10 years. So you know that after 1 year you will get 10% per annum. Not 2 like 7%. So So you know that I will get 7% per annum for 1 year. But if I need cash in the middle, nobody will call for you to sell. But actually worth something, but nobody just wants to do it because there's no secondary market pricing for this. We call it over-the-counter product. But if you buy a bond, then probably you can sell it for secondary market. Then the third risk is the country risk and the political risk. Then is the expressed to a specific country or jurisdiction. What does it mean? Say for example, if you buy a Argentina bond, and then Argentina has exchange control. So okay, put it away. I quote another example. Actually Argentina. I remember that when I was in HSBC many years ago, there's a bond issued by HSBC Argentina, and then pay high interest rate. Say like when the interest rate normally is 5%, he pay 8%. Same HSBC, but in Argentina. So seems okay. HSBC in Argentina will not go bankrupt. It's a full branch of HSBC holding, so it will not go bankrupt. Right, it will not go bankrupt. But when they mature, Argentina has exchange control. It did not allow you to remit the US dollar out. That means your dollar, your amount of the currency have to remain with HSBC Argentina. So that means you cannot use your US dollar unless you fly to Argentina. So that is the country risk and exposure. That's why the HSBC Argentina will pay a high interest rate than HSBC Hong Kong. That's the country risk. Same thing happened in Philippines before. In the 70s, Philippines is still not as well developed, but a lot of foreign banks have already in Philippines. And when I first joined Citibank, they have the training center in the Philippines. I asked my senior, why HSBC Citibank has a training center in the Philippines? It seemed to be nobody likes to go to the Philippines for training. So, but they have because Citibank has quite a long presence in Manila. The reason why, because there's a training center in the Philippines, because Philippines has an exchange control. Citibank cannot remit their profit out of Philippines up to a certain amount. That's why they have retained a lot of US dollar in the Philippines. They cannot take it out. So what do they do? So how about they establish a training center, spend it. So that's why every people fly to Philippines to do training. So this is exchange control. So even you have the money, but you cannot use it. Same for China. So right now China, especially exchange control country. So if you make a lot of renminbi in China, you cannot take it out because of exchange. This is the country risk, etc. So that's why in China, same bank, Deutsche Bank or other bank pay US dollar as a high deposit rate than the Deutsche Bank in Hong Kong, because you know that your US dollar is in China, not in Hong Kong. This is the exchange control or the political risk. Same thing happen right now. If you invest in China, because of the geopolitical situation, money are coming out from China. That's why also the country risk. So counterparty risk is the counterparty, the credibility of the dealing counterparty. So say for example this one. If you're dealing with a bank, okay. If say like another, so same terms. If another smaller financial company offer you same term, offer you 10%. But this is a small FX broker. Will you trust it? So this is the counterparty risk, because he may not be able to honor, or you take it as credit risk of himself. So this is the counterparty risk. Or if you enter into a contract. So remember that in 2008, Lehman Brothers go bankrupt. So what happened is that. So I give you an example. You know why Lehman Brothers bankruptcy will affect the whole financial system. Okay, if you are Citibank, Lehman Brothers. So they enter into a dollar-yen transaction. So Citibank, and then Citibank sell yen, and then Lehman Brothers buy US dollar. Say for example, 120. Say for example, it's a $1 million same deal, so it would be 120. So, right, very straightforward. Right, so say for example, Citibank enter into a contract with Lehman Brothers on the day, same day of the Lehman Brothers go bankrupt on US, declare bankrupt. So see, sell yen and buy US dollar, the settlement day on that day. So on the the trade is that so if Citibank sell 120 million yen in the exchange for 1 million, very straightforward, right? I sell and buy and then he sell US dollar and buy yen. So very straightforward. Okay. The risk is on the movement. Seems to be logical, right? However, so in the daytime, Japan time, our same time zone. In the morning, in the morning, so settlement. So Citibank will pay 120 million to Lehman Brothers in his Japan account in Tokyo. And in the night, Citibank expect Lehman Brothers will pay 1 million to him during the New York time, different time zone. Then this disappears because Lehman declared bankrupt and stop paying. What happens? So if you are exchange, suddenly you lose one leg. Instead of exchange, you become your lending 120 million to Lehman Brothers. Because you pay the yen to Lehman Brothers, but you don't get the US dollar. And then next morning comes back, okay, Lehman Brothers disappear. So think about that. There's so many these kind of transactions happen with Lehman Brothers. Some is settled on the same time, you see in the futures. So for example, okay, Lehman Brothers declared bankrupt. That says that another settlement, 1 month. I have to buy yen and sell US dollar with Lehman. Do you want to honor? I don't know, because I will not pay them anymore, right? Because I know that he will disappear already. So I will subject to FX risk this time. Then, so that's what create a lot of turmoil on the whole financial market, and nobody knows how many outstanding contracts are there on the street. Because say for example, if I'm an FX trader, so I do this trade, and then at the same time I may square it. I buy against US dollar and maybe 121, and I make 1 point, right? It is normal trade. But since right now this is not settled, I don't know how to settle this one. I don't have the US dollar to pay to another party. So this is because in the interbank side, let's say for example, I do the trade with Lehman Brothers. At the same time, probably I buy US dollar, I sell yen to buy US dollar, and at the same time maybe I do another trade with Hong Kong Bank. I buy yen with Hong Kong Bank with US dollar, and another same. A bit of difference. I make the difference for the trader. But suddenly this trade is not settled. The rest become nobody know how to handle. And then nobody know how many trades with Lehman Brothers. So that's why the whole financial system was collapsed, freeze, and then they don't trust each other anymore. Suddenly they collapse. So that's why counterparty risk, a lot of people will underestimate. And then also at the same time, this is on the interbank, but apart from the interbank, so like in those days we have I was in HSBC those times, and then we have Lehman Brothers as the counterparty of HSBC for the client. So, and then the Lehman Brothers disappear, how about the contract with the client? Nobody will honor the contract with the bank. So the bank, how can you settle with the client? So to create a lot, you can see the counterparty is very important. So nowadays, when if you're HSBC, you enter into a contract with the bank, and then they said that it is for on behalf of Lehman Brothers, then you know you're taking this risk, the counterparty risk. This is definitely the credibility of the dealing counterparty, whether they will honor what they would like to do. And then leverage gearing is the portfolio subject to loan or margin call. So this is also if this is gearing your loan and margin call, then you have to monitor the volatility. And concentration, do you have too much exposure on a single asset or security? It's very straightforward. If you $100, you put $100 in a single stock, then you are concentration. All these are risks we will quantify. And then I will talk about risk premium. So how much risk is justified? So the concept of risk premium is that the extra risk premium, that means extra return. So investor demand incremental return for taking additional risk. So when you're taking additional risk, you should be rewarded. Just like so there's a different types of equity risk premium. Like equity risk premium is equal to the equity return minus the treasury bill. So remember when we talk about the capital asset pricing model, that's called the risk-free rate or the market rate. So the risk-free rate in the financial market means the 3 months US treasury bill rate. So why we call the risk rate? Because this supposed, according to the modern financial history capital market, is supposed to be the lowest risk investment return, the 3 months US government bills or the monthly investment government bills. So anything above this, you deserve a risk premium. So say for example, you when you invest in equity, you expect the return there will be a premium higher than the T-bill rate. When maturity risk premium, that means you invest something longer term than the T-bill, you expect a high return. A default premium is that's a credit risk. So you buy a corporate bond, you need something that higher than the corporate bond. So for example, like US Treasury 3-year is say 4.5%, and then New World Development on 3-year gives you 8%. So the difference will be the risk premium, the credit risk premium. That means when you buy New World Development Bond, you think the default risk can be quantified to be around 4.5%, 3.5% per annum. That's why in the market they call it credit default swap. The credit default swap will be quantified as the credit risk premium of that specific issuer. For example, like at one point in time, the U.S. government also had credit default swap. People were afraid that U.S. government would default. But I don't know how they price it because the underlying issue is treasury. But however, like China, the credit default swap is rising because people worry about China will default. Or even say like banks, during the Lehman Brothers, all the banks credit default swap. And one of the company that got into bankrupt, almost gone to bankrupt, is AIG, because AIG wrote a lot of credit default swap on the mortgage-backed securities in the 2008 level. So that's why credit swap is somehow explaining part of the default premium. And expected return is the historical risk premium plus the current risk-free rate. So that is a more generic term. And liquidity premium is the additional return for lockup. Say for example, like if you buy a bond, 1-year bond 5%, 2-year bond 6%, the liquidity formula is 1% per annum. So this is because you want to stay liquid, you have to pay a premium. So Is low risk means no return? Yes or no? Low
Not
risk, no
necessary.
return.
Not necessary.
Okay. Yes, low risk,
Yeah.
low return. Sure. If there's somebody telling the product is low risk, definitely that means low return. Why? Because you're not, the return is high return because your risk premium or because you're taking additional you can high return. But high risk, high return, is it true? Supposed to be, but not always the case. Because some of the risk is that you, how to say that, some product comes up with high risk, but not necessarily give you high risk. So some of the is unsync, not in proper ratio. And high risk, low return is the, if something is high risk and low return, probably you misunderstand the relationship of the product. If something that is, the return is there and then you think it is high risk, probably it's not right. Probably you're thinking too much about it. So think about that. So what situation will happen like that? So say for example, if you're a PRC resident, you live in China, you use renminbi every day, and then you buy the renminbi government bond and give you 4%. I think okay, fine. But for US citizen, renminbi give you 4%, you think it's very high risk, low return, because renminbi to him is currency risk to American, but renminbi to Chinese person is not currency risk. That's why the same product to different people may mean different. It depends on where you are. So say like you live in UK, you buy UK government bonds. For British, doesn't think it is currency risk, but for us it's currency risk because we are using Hong Kong dollar here. We are not using sterling there. So that's why high risk means also there is some mislinkage between the product. Low risk, high return. If somebody tells you this is low risk, high return, think about it is impossible. Don't trust it in, which is don't be fooled by the market time. So nothing is low risk, high return. And then if somebody gives you some return, and they said this is a risk, and then probably he will misunderstand himself or misrepresent himself, misrepresent product, or he hiding something from you. You should probably can discover more risk involved. So like for example like this one, like the new currency deposit. Okay, you now deposit the Hong Kong dollar with a special term, I can give you additional interest. So it seems the same. Hong Kong dollar deposit with high interest rate, and then at the maturity getting Hong Kong dollar is nothing happened. So the risk is nothing happened. So what if something happened? The risk is something will happen. So that's why low risk. So remember these phrases: low risk, high return is impossible. So low risk, low return is a rational understanding and quite probable. And so what we would like to do is that if we want to take, if we need to take high risk, I would expect high return. If you taking something which is not supposed to match with return, just forget about it. Say for example, how to decide it's not a science. Say for example, right now, risk-free rate is 5%. If somebody unknown to you, say, ask you to borrow for 1 year, I give you 7%. Unknown, 7%. And then while you can buy for example, another corporate bond or Euro development, start again. So if now deposit 5%, if somebody comes to pay you, say, okay, I borrow you money for 3 years, I give you 10%. But his credit, you don't have no way to judge his credit worthless. So he pay you 10%, and then if you think it's okay, then you lend your money. But you find that Euro bond give you 11%. Why I buy Euro bond? I'd rather buy Euro bond taking similar risk than by lending to somebody which is unknown to me, a small developer. So that's why you have to compare the risk matrix in the market in order to justify whether the risk and return profile is fair. So different market situation, different timing may affect the risk, but you can always compare the market in terms of that. So here's some exercise for you. Assume you are a Hong Kong investor. Your base currency is Hong Kong dollar. What are the risks of the foreign products? Number one, Ministry of Finance bond issued by China, renminbi bond, 10 years, pays 3.5% per year. So assume you're a Hong Kong investor, so what are the risks? Think about it, and then anybody?
China government stability.
Yes. One more?
Exchange
Yes.
limitation.
You're taking the exchange risk and the credit of the China government. But I would say the China government renminbi, you should not be taken as a credit risk, because China government issue renminbi, they can issue whatever they want. so basically, it's not just like US Treasury issuing US dollar. They can issue whatever they want. So that is, they're not taking credit risk.
Okay.
So it is the benchmark. So basically, it's the currency risk and also interest rate risk, because you're buying a 10-year bond with 3.5% interest. If interest rate goes up, the bond price will go down. So there you're taking the interest rate and the currency risk. Second, Apple share. You buy the Apple share. What risk you're taking? Market risk, US equity market, and also Apple specific or index research. Third, UBS China Equity Fund. What risk? UBS China Equity Fund.
Management risk.
Yes. What else? Yes, but more specific, like China equity market beta, market beta. You're taking the China equity market beta. Remember we call it beta. So you're taking. So say for example, why do you invest in China equity fund? Because you think China equity is a good market to invest. So you buy the China equity fund. Why don't you buy the tracker fund, the ETF? Because you think UBS will do better. So you're taking two risks. One is the China equity market risk, and also the manager's decision making. So the fourth one, US dollar bond issued by Petrobras, a Brazil government sponsored oil company, 2 years, 2.6.5%. What kind of risk? Yes, or you can call it credit risk, because you are issued by Petrobras. You're lending money to Petrobras, so you're taking a credit risk of the Petrobras, a 2 years bond, and then I would say minimum interest rate risk, 2 years pretty soft, and also the political risk. If Brazil suddenly have an exchange control, all the Brazilian company cannot repay foreign debts, because this is Brazil is the currency is not US dollar, it's the Brazil real. The fifth one, selling a put option on sterling against US dollar with 5% margin. Yes, exchange risk. One more. Margin. You're taking the margin call. Yeah. So buying a put option on sterling against US dollar with account in a small local FX broker. What's that? The main risk, counterparty risk. Because so here is that I buy a put option. That's why your risk is just the premium you pay, so very little FX risk. And then the main risk is on if you're right, if the local FX broker disappear, even you're right, you cannot make money. That's right. That's like people buying horse racing through the illegal. So some people buying football matches through an illegal agent, and then the agent disappears.
黑吃黑。
So UK residential property fund with 3-year lockup managed by a reputable international fund manager, say like Blackstone, for example. What are the risks? What risk you're taking? Why? Okay, first of all, why do you want to invest this market?
Because you believe in UK residential property,
Yes.
and then the management risk.
Yes. Hmm? Yes. So because it's a 3-year lockup, so that means you think that you will invest in UK residential property, and then they will go up in 3 years time, and then this fund manager will help me to manage it better. Of course, I put it reputable here. That means this is a very prudent manager, better than a small fund manager. So that's why you're right. Accumulator on 10 cent share with 2 times gearing, margin requirement 20%. What the risk? Leverage risk more. It is the underlying equity. So if you okay, you can do accumulate on 10% with no gearing or no rather requirement by paying full. That means you're not taking the leverage risk, but this is like leverage. So in the future lessons we will talk about structured product. I will talk about this in greater detail. So iShare S&P Healthcare ETF. Yes, mainly market sector risk, and of course the issuer is also important. But here we use the iShare. iShare is one of the largest ETF issuer, so that's why the probability risk is pretty low. Yeah. Global credit hedge fund by a new startup fund manager, 1-year lockup quarterly redemption.
Manager risk
Manager risk
and liquidity
yes
risk.
liquidity risk
and counterparty risk is that global.
So mainly it's the manager and the liquidity risk. And this credit hedge fund, you can say that it's your exposure on the credit market. But since it's a credit hedge fund, they can trade whatever. So this is not mainly the risk, is how they make money. So if you think the credit market doesn't give you opportunity to make money, so it's no point to invest these managers. So that's why in all the products, you can identify certain risks. So it can combine several risks together. I can give you a lot of these types of examples, but just something that you bear in mind. So when you say, for example, if you have a portfolio of combining all these together, if you invest in 10 products and then including that, so probably you find that you have a diversify your risk. So if Apple shares goes down but China equity goes up, I'm okay, right? But if say, so you see that you find that you will not have all of a sudden everything goes down together, unless a war. Yeah. So I think that like if Apple share goes down, the ETF may goes up, healthcare, or the bond will goes up, interest rate goes down. So that's why if you understand, so that's why in this portfolio, say for example, you assume a 10% each, you will find that I have allocation different risk with different percentage, and then you combine. This is how a portfolio be constructed. So I'll end today. So I will catch up a bit more next week. Next week is holiday. So have a happy Chinese New Year.